Hello and welcome back to another video. Today we're going to be looking at corporate bonds and I'm going to be explaining in detail exactly what they are, the different types we can get, as well as all the benefits and disadvantages. So make sure you watch all the way to the end so you don't miss any important details. So to start with, what are they? A corporate bond is a type of debt security issued by a corporation and sold to investors. When an investor buys a corporate bond, they are effectively lending money to the company. In return, the company makes a legal commitment to pay a pre-established number of interest payments at either a fixed or variable interest rate. When the bond expires or reaches maturity, the payment ceases and the original investment is returned. The backing for the bond is generally the ability of the company to repay, which depends on its prospects for future revenues and profitability. In some cases, the company's physical assets may be used as collateral. Corporate bonds are typically seen as somewhat riskier than US government bonds, so they usually have higher interest rates to compensate for this additional risk. The highest quality and safest lower yielding bonds are commonly referred to as AAA bonds, while the least creditworthy are termed junk. So are there different types of corporate bonds? Yes, there are different types of corporate bonds. To start with, there's public utilities, and these bonds are issued by public utility companies such as electricity, water and gas companies. Then you have transportation. This category includes bonds issued by transportation companies, including airlines, railroads, and trucking companies. Then you have bonds that are issued by industrial companies, and then you can also get them for banks and finance companies. And finally, there are international issues, and these are bonds issued by companies in the international market. So what are the main benefits? To start with, there's better returns. Corporate bonds generally have better returns than government bonds. It also provides a steady income stream. Many individual investors, especially retirees, in order to obtain a steady income stream. Also the liquidity. Their liquidity is one advantage of corporate bonds. Active bond traders can benefit from selling bonds that have risen in price or buying bonds after they decline in price. It's also good for choice. Bond investors can buy short-term bonds with maturities of 5 years or less, medium-term bonds that mature in 5 to 12 years, or long-term bonds that mature in more than 12 years. And finally, it's good for diversification. Corporate bonds offer diversification for an investment portfolio. So what about the disadvantages? To start with, there's a credit risk. If the issuer goes out of business, the investor may never get the promised interest payments, or even get their initial investment back. Also, interest rate fluctuations. The value of a bond can decrease if interest rates rise. There's also market volatility. The bond market can be volatile and the price of a bond can fluctuate based on market conditions. When compared to stocks, bonds also typically provide a lower return. And finally, there's a lack of capital growth. Unlike stocks, bonds do not offer the potential for capital growth. So this has been my video explaining corporate bonds. Hopefully now that you've watched this video, you understand everything you need to know about them, and that should assist you if you're looking into investing into corporate bonds. So I hope you found this video helpful, and thanks for watching.